So, evening everybody. Thanks for coming out tonight. So I'm going to talk about Scirocco Energy, and as the title here it says, it's an investment story in transition. Scirocco's a AIM-listed investment company that's been around quite a while. Historically, it invested in natural resource opportunities, really all over the world, very diverse portfolio. Trouble with that is they tended to need a constant supply of cash for the next piece, and the next piece, and the next piece. And they tend to be in jurisdictions with fairly uncertain timescales and jurisdictional processes to turn them into cash generative assets. So over the last 3 years, myself and my colleagues have been transitioning Scirocco itself into a more go-forward story that I believe is more interesting, frankly, and more capable of delivering value under its own steam. And that's to look at a strategy based in transition energy assets that are cash generative and allows you to recycle cash into more assets, and you've got that virtuous cycle. So as we go through the presentation, hopefully that will come out. I'm going to start by talking about where we're headed, what the target is. I'll give you an update on where we have been and where the company sits today. And then I'm going to talk about the first investment platform that meets the strategy, which very interesting situation in anaerobic digestion and biofertilizer production. So, disclaimer, everyone's got one. I'm particularly proud of ours, but I'll let you read it later. It basically says, do your own due diligence. So, introduction and strategy. So I mentioned we set out our stall with a new strategy. And that's to build a portfolio of assets within the renewable or low carbon energy space. And we categorized it into 3 blocks: energy, circular, and vector, as you can see here. Energy are assets that generate energy by renewable or low carbon means. So you can all think of some of those. You've got solar, wind, geothermal we heard about, and indeed anaerobic digestion, which we'll talk about a lot more in a second. Circular is the refining or recovery of a valuable component from some form of waste stream that would otherwise be thrown away. And by doing so, you're recovering energy that would otherwise be required to manufacture that from primary sources. And then vector is kind of everything else that doesn't quite fall into the first 2, but really it's about transmission, storage, or delivery of energy in a low carbon context. So those are the sort of things we're looking at. How will we do it? So the investment model is to work with teams who really know their business, invest in them and their plan to grow a business and buy assets. We'll come on and talk about EAG in a lot of detail in a minute. Because they know what they're doing, they know what good looks like in their assets, and they know how to manage a portfolio for growth, we intend to be the people who stand behind them, provide access to capital through the public market. I love a flying brick diagram, and that's what's there in the middle. And really it's a simple description of how, by buying a series of assets, because they're cash generative, they typically attract the use of debt as a source of leverage and to offset the use of equity in acquisition processes. And you can see that with this bar here. This is debt and equity requirement. By growing the portfolio to a certain scale, by using the right kind of tools, and by optimizing operational performance, we see, a relatively modest value growth represented by the large blue bar there. You pay back the debt, and you can see that you've grown equity value in the process. And we intend to do this with a number of platforms in energy, circular, and vector. And we think EAG is a very good example to start with. Very experienced team, strong pipeline of opportunity. Path to upside is very clear with the assets, and we'll talk about that in detail. And they can access appropriate leverage on the way in. Excuse me. So I said I'd tell you about where we've been and where the company is at the moment. In transitioning any business from a historic strategy to a new strategy, there's always going to be a small group of shareholders that actually quite liked what you were doing before, even though you can probably tell them why there's about 15 reasons why they shouldn't be doing it anymore. That was the case, and we met with a little bit of resistance through the course of late 21 and 2022 as we came through this. I believe we're now out the back of it, and in fact a number of the original resistive shareholders have been in contact with me and told me they've increased their holding and bought more shares through the back end of last year. But effectively what we've been doing is we've been selling the historic natural resource assets that the company held, turning them back into cash. The main one is a gas asset in Tanzania called Ruvuma, and that's working its way through government approvals in Tanzania at the moment. But effectively, that has provided us with a source of capital to begin investing under our new plan, and the completion of Ruvuma, which I'll talk about in a minute, will provide a significant shot in the arm going forward. Now, where does that put us at the moment? Graph on the right, not massively flattering. Share price, I believe, represents a very attractive entry point. You can see where it's bumping around there. Looking at either the receivables or the net asset base of the company as it is today, you can read these at your leisure, but effectively, the unrisked value of the cash that the company expects to receive over the next 2 to 3 years from the Ruvuma sale, about $16 million. That roughly equates to 1.5p per share. The net value of our ownership in EAG based on the asset base there is about 0.4p per share. And then there's bits and pieces that probably bring that up to 2p a share in round unrisked value. So 2 pence a share, look through NAV, and you can see over here the price is bumping around 0.23, 0.24p. So fairly meaningful upside, and that's what really supports the statement at the bottom of the chart there, which is that it feels like a very attractive entry point into the story. Just to give some context around the Ruvuma sale, again, this is a historical asset the company's been in for about 10 years, funded through various rounds of exploration, drilling and seismic acquisition. Still a very long way to go in terms of capex and timeline to bring it into production, at least 3 years, and probably net to our share $35, $40 million. We felt there was better places to spend our time and money that could give more immediate and accretive results. So we agreed with Wentworth Resources PLC in the first instance to sell that back earlier in the year. That was preempted by the current operator, Ara Petroleum Tanzania, and we kind of finalised everything in September, so we're off to the races. We're moving on well with the completion timeline, and basically the main point on here is that $16 million is the total body of cash that we expect to receive over the next 2 to 3 years in the form of lump sum payments linked to certain events like completion of the transaction, FID for the development, and then a share of revenue from first gas revenues. And obviously that value then gives us a series of payments dated out into the next few years, which we can recycle into the strategy I started with. In terms of completion, we've got a big green tick against the FCC, is the Fair Competition Commission. The Tanzanian Revenue Authority is the conversation we're engaged with right now. It's going pretty well. And the last two are really much simpler and more straightforward once you have the taxman on side. So we're still talking about an expectation to complete the deal before the end of March, so in this current quarter, which would be a great result and allow us to get on. So the main body of what I want to talk about is EAG. So that's Energy Acquisitions Group, private company that we invested in back in 2021 and provided capital for them to buy their first anaerobic digestion plant. I think it provides a really good case study for what we would like to then roll out in other areas like circular or vector and potentially other energy, transition energy sectors. In terms of the timeline, I really just covered what I wanted to say, but they've been going since 2019, identified a really large and interesting portfolio of opportunities to get after. The team themselves are confident of being able to get into at least 20, if not 48 distinct AD plants. And they've got a legacy of working with AD plant owners in capacity of operations, design, build, and ownership. The first deal was done in 2021. That is Green and Generation Limited, which is GGL on this chart. And what they've taken forward is, by looking at technologies that can augment AD plants, is they've now identified a way to turn the left behind digestate material into biofertilizer, which is really very interesting because it's kind of capturing the nascent nutrient value that would otherwise just be spread on local fields and be really dealt with as a disposal problem. Really just to cover on that, what is the anaerobic digestion? I mean, it's effectively an industrialized cow's stomach. As you drive around, I came down from Aberdeen today, and I think I counted 3 different distinct sites where you see these green domes in the countryside from the train, and it looks actually quite like that there. The inputs are a mixture, depending on where they are. You actually find wastewater and food waste is quite common in the larger municipal sites. We've got one in Aberdeen, which is taking food waste from the municipal collection and taking that forward. The sites we have been concentrating on are more agricultural, and therefore the input is livestock waste and crops. That produces biogas, methane mainly, which can then be used directly injected into the gas grid, so you earn gas price for that. Or you can run it through a CHP plant, turn it into electricity, and sell it as power. Over the last 12, 24 months, you've seen your own energy bills coming through the house. People who have already got static power and embedded power generation and existing plants have been doing pretty well out of that. What I mentioned just before we came onto this slide is digestate. What's left behind is this kind of slurry. There's no polite way. Anybody can come up with a polite way to say slurry. I'd be delighted and see me afterwards. But very nutritious from a point of view of agricultural nutrients, so nitrogen, phosphorus, potassium. And we have basically been working with a group based up in Aberdeen that we're aware of that has the technology to take that digestate, process it, and turn it into basically an organic fertilizer alternative to chemical fertilizer. We've all been watching the news. Chemical fertilizer very expensive, primarily driven by being made from methane, and quite sensitive to geopolitical issues at the moment as well. So what this actually offers from a distributed network of anaerobic digestion plants is the ability to generate organic, local fertilizer, which can then be reused in the agricultural market. So really very interesting. And a huge value increase, as we'll see in a moment, on an AD plant that you purchase and then install that equipment on. So the investment case, less concise than the last speaker. I was really quite jealous of his investment case slide, and we'll talk afterwards. But my outlook on the near term, what did I design the strategy for was looking for something that was inflation adjusted or inflation proof, because I think we all recognize we're in an inflationary environment. I don't see that going away anytime soon. Don't believe the peak inflation narratives that we are all being spun. So what do you want in inflationary times? You want to own a real asset that generates cash flow, ideally where the revenue line is index linked, and where you've got that growing cash flow and you can reuse it by investing in more capacity without hitting constraints. And I think that's exactly what we have here, and EAG is such a good opportunity to do so. Lots of market headroom in the AD market in terms of targeting existing assets that are already there working with operational performance that can be demonstrated. And the upside comes from carbon credits linked to the organic fertilizer and the organic fertilizer sales itself. In terms of uncertainties and mitigations, I would say the main things are accessing capital at the right pace so that we can feed into and keep buying assets. But I think once we get going, you'll see the cash performance in a moment. You can actually see there's quite a lot of cash to be recycled out of these plants once we've got a kind of minimum level. Just to reinforce that point about headroom in the market, each of these dots represent existing plants. You can see they're either agricultural or rather operational or application approved all over the UK. And you can see in Northern Ireland where the first plant from the EAG purchased is up here. There's a really good distribution, and there's a number of those plants that are already in dialogue with the EAG team. 1 year of greening, bought the asset in 2021, forecasting about £450,000 of EBITDA profit for the first year, and we've outperformed that by probably about 30%. Some of it is linked to pricing, which is obviously the tide that lifts all boats, but some of it is driven by operational availability, working the assets harder, investing in them in terms of CapEx to improve performance and reduce downtime. And I think that really is a testament to the operational capability of the team themselves and getting to know their equipment. So we believe that Greenan 0.5 megawatt AD plant is a really good unit size to then look at deploying further out in the market. There we go. And that's really what this says. So what I'm really trying to describe here is, for an investment company, how can we roll out units of capital to grow our capacity and recycle the cash we get from plant A into plant B, C, D, and E. And that's what this is trying to tell you. So you have to define your unit of investment, and that is a 0.5 megawatt AD plant that looks quite like Greenan. There's lots of them in the UK. From the chart before, there's about 400, more than 400, distributed all the way through the UK at different sizes, but probably about half of those are of a sort of Greenan-esque size and profile. I'm just really going to talk to the charts on the right in terms of time, but effectively, buy an AD plant, debt, equity, you optimize it so it has a degree of value uplift, as you saw in Greenan. You install the biofertilizer plant, and really just for safe side economics, I'm assuming we use equity to fund that, and then the increased value of that combined unit producing power or gas and biofertilizer takes it up to about the £9 million of enterprise value when you look at what these things are valued at with that level of profitability. So on an end-to-end basis, that's your total equity investment, debt, same value, 9 million, pay back the debt, and you can see that you've achieved a reasonably interesting uptick in equity value over your hold of that asset. The key thing out of that is, once done, you're looking at an asset that's capable of generating around £1 million a year of EBITDA, proxy for cash flow, which can be recycled into buying the next one. So if you buy lots of them, and that's what this chart tells you here, over a period of time, what does that portfolio look like? Well, basically, you can just see the benefits of recycling cash all the way along here into buying the next and next one. And so that's 5 anaerobic digestion plants and 3 biofertilizer plants, cost about £25 million, assuming about 65-70% debt ratio, but the value, enterprise value, based on the cash generative qualities in these plants, certainly north of £40 million. So you can see a pretty material uplift in equity. And I think the key thing here is you're looking at very stable index-linked cash generation amounting to around the £5 million a year mark from that sort of thing. And really just to finish off that story, the guys at EAG already engaged in detailed due diligence and legals on a plant that could very happily use the capital we see coming from the Rovuma completion. So we're already on to the next one. So what are the key takeaways? The plan for 2023 and 2024, I'm not going to read every line on that page, you'll probably be very happy to hear, but effectively that is buying a number of plants that are already identified, many of which preliminary diligence is already done. Effectively there's a large hopper of opportunity to get after, and we can start recycling cash from things like the completed Rovuma deal into pursuing that portfolio chart that we just looked at. But I think in terms of qualitative key takeaways, I think first and foremost, we've made really strong progress in that transition of the company itself, moving from natural resources, uncertain timelines, uncertain cash and performance and everything else, into much more predictable, much more cookie cutter, recycling cash flow into the next asset and the next asset. I described it to my kids as like breeding rabbits, and I got kind of screwed up faces, so I wasn't going to use that metaphor tonight. I think another key point to make here is that where our share price is just doesn't seem to bear any relation to the embedded value based on receivables and the asset value we have. Seems to be a common problem in the room from listening to earlier presentations. And of course I would say that the Rovuma divestment is on track for completion later in this quarter, and that then obviously frees us up to support EAG and really get after it. And I think hopefully from that very rapid rattle through EAG, you can see we've got a replicable strategy to buy another one and another one and another one. And concentrating on that asset class and just being good at that can actually generate a very interesting and substantial business. And I think that's probably where I'll stop. So graphically, we want to buy assets, add a technology lever. So in the case of the anaerobic digestion is adding the biofertilizer plants, harvest cash flow and recycling it into buying more assets, and you create a virtual cycle and growing your business. That's probably where I should have started. Right, thanks.
Thank you very much. Thanks for that, Tom. Questions in the room? One just here.
So the fertilizer that's coming from your aerobic digester, have you actually produced that and sort of given it to farmers to trial and test, or how far off is that?
Yeah, so we've basically done trials. We've taken digestate from Greenon and 2 or 3 other AD plants that we've been looking at. We've passed it through a pilot process and generated the stuff. There has been growing trials done, but they're not concluded yet, because you obviously actually have to go through a growing season to fully test that and test it on yields and things like that. So we haven't seen the results of those. But the assays of the material that comes out the back end of that process are pretty interesting from point of view of, well, NPK levels that come out the digestate, and when you compare them or benchmark them to commercial fertilizer, then you're actually comparing that concentrated digestate material with fertilizers that are selling for hundreds of dollars per ton at the moment. So it tends to all fit together. It basically supports the thesis and the numbers we've put here.
What sort of costs would this
So
cost?
for a 0.5 megawatt AD plant like Greenon, about £2 million, and I would say that's a central estimate. It could be a little bit more depending on just how rigid the water discharge limit is, and therefore just how good water polishing technology you need to apply. But there's actually scope for it to be less than that. But again, all those numbers are built into the models we've presented here. Okay, thanks.
Got another question, gentleman, just at the back there.
A lot of the AD plants have been built and are owned by larger farmers and estates, and I can't see why they would particularly want to sell them to you. How many of those 200 or 300 out there do you think are actually in play for you?
Yeah, so I mean, there certainly is a cross-section where they've been successful. What we've found is that a lot of the opportunities we have in the hopper are with farmers and multi-generational farmers. They were given third-party funding support, not given, it clearly had a cost, but they obtained third-party funding support, say 5-6 years ago, when a lot of these plants were built. And the nature of the funding means that they've now got this wonderful operating plant with great operational characteristics, but fundamentally they're underwater, or they haven't created any value for themselves because of the funding mechanism. So they're actually looking to get out of that. So I wouldn't say it's a driver of distress, but there's certainly the value expectation of building these things in the first place, because of the financial structure it was taken on, hasn't delivered for them. And so there's no embedded value or little embedded value. So what we're finding is there's quite a large number of sites like that.
Excellent. Was there any follow-up to that question? No. Any more questions in the room? One just here in the middle.
So you're generating cash flow with the products coming out. Do you also generate cash flow with the feed coming in?
No, you have to pay for that.
Okay.
Yeah. So
you have to pay to take the waste. They don't.
Yeah. So to actually go back to the other gentleman's question, or link to that, a lot of these plants that we're looking at agricultural settings, and they are single farm plants. So they were constructed on a plant and sized because of the amount of silage or energy crops or whole crops left behind after barley or wheat production or whatever. So they could take the material from that size of farm and then actually make use of it and turn it into energy. So on because of the different taxing arrangements, typically what you find is that the farms are set up the AD plant in its own company, and there's a transfer pricing arrangement between the farm itself selling its produce, and we tend to adopt those. So there is a cost to it because we don't own the agricultural land or the means of production. But they are pretty, they're long-term supply arrangements. For example, Greenan has got, I think, a 10 or 12-year supply arrangement for a certain quantity of silage, animal manure, whole crop and maize.